Today we're going to be taking you through the steps to move a company from your name into a limited company. Stay tuned to find out more. Hello and welcome back to our channel and podcast. My name's Gemma and here at WS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Iftika joining us again. Now, for those of you who don't know Ifti is a trained accountant and mortgage advisor who's been in the industry for over 10 years. He is also one of the founding partners here at WIS. Welcome back, Ifti. How are you doing today?
Hi, I'm well, thank you. How are you, Gemma?
Yeah, really good, thank you. So today is a really exciting podcast. Today we're going to be talking about moving a company from an individual name to a limited company. So I guess what I'm wondering is, why would somebody want to move a company from an individual name to a limited company?
Okay, there's only one main reason I can think of. That's mainly tax. That's the reason why most people would do that. Obviously, some of you would know by now because we've done previous podcast on this as well, that there's something called a Section 24, which came into full flow this year, right? So this financial year, that's very active. So you've got to be a little mindful of that. That's the reason why people are considering moving properties from their personal name to a company. So that's why this is becoming popular. I will take an example because this will always help, right? So before Section 24 came into play, say an individual, let's say they earn 10,000 income, and let's say they paid 3,000 as interest, they would have made 7,000 profit. So if they were 40% taxpayer, they would have paid £2,800. But now what's changed is on the 10,000, you have to pay 40% tax, which is £4,000. But then the government, because you paid 3,000 interest, they will give you a small rebate kind of thing, which is, if you take 3,000 and take 20% off that, that's £600. So 4,000 minus 600 is £3,400. So you now pay £600 more tax. So that's the reason why a lot of people are considering companies. Now, if you take the same example with a company, what happens is if your income is say 10,000 and your interest is 3,000, you can deduct the interest in full, which means on the 7,000 profit, you pay corporation tax. Now, corporation tax stands at 19%. So 19% of this kind of works out to about just over £1,300, right? So that's a massive saving for most people. So therefore, that's why people will look at this route as a thing to do going forward. Just be mindful. This example which I use can be complicated from person to person because they might have other things that they may have to consider. Always consult an advisor, somebody who knows about tax, because if you're taking the company route, there can be dividend tax you may have to pay. So this particular example I use is assuming you take minimum dividend tax, right? So talk to an advisor on that because the answer may vary based on your circumstances. But by and large, this formula works for a lot of people.
Sure, but if we're just breaking it down a little bit, we're talking about interest from a mortgage?
Yeah,
okay.
That's the interest on the mortgage. Yeah, that's right.
Okay then, cool. So then how easy is it to set up a limited company?
Very simple. You could go to a company's house, pay £13 I think nowadays, and you can set up a company. But my advice is don't do it, right? You could do it if you know what you're doing. Please get advice before you do that, because if you're structuring a company and if you're structuring because of Section 24, you need to know how you set it up, because there are different ways you can set it up, because your shareholding structures can be structured based on your circumstances and where your money is coming from as well. So if you have money in your limited company, it can be a layered structure. So there are various structures, right? There are directors' loans which you can use. So based on that, you need to know exactly what your plan is. So based on that, you need to set up the company. So yes, it's £13, but just don't do it. Get some advice before you do it.
Okay, so how easy is it then to maintain this company once it's set up? Is it just hard setting it up and then it's easy to run?
Okay, so to do a comparison, if you're an individual against a company, so the company, you need to do a set of accounts. Even with an individual, you need to do a set of accounts. But for an individual, you do a self-assessment tax return, which is a little bit more easier than a company. Now, if it's a company, you've got to open a separate bank account. And you have to file accounts with company's house, and also you got to file a corporation tax return. Now that's something that you can't do yourself most of the time, because to submit corporation tax HMRC wants it in a particular format, and it has to be submitted in a particular format as well using a software called XBRL, right? So not everybody has access to that. So you might need an accountant to help you for sure. So usually if your structures aren't complicated, the accountants might charge you maybe 40, 50 pounds a month. This is assuming you don't have payroll and you don't have VAT. Very unlikely you're going to be paying VAT anyway. So there is a little bit more work compared to an individual. But I don't think it's massive amounts of work, because even if you are an individual, you've got to maintain receipts. And of course, you've got to do your accounts before you plug in the numbers in your self-assessment. So with the company, you've got to do it. But you'll probably need an accountant's help. So there is a little bit more work involved with the company.
Okay. So then what kind of things do you need to be mindful of when moving the property to a limited company?
So first thing is you have to do a sale, right? So you can't just do a remortgage to the company. So that doesn't work, because company legally is a separate person by itself, right? Even though it's not a real person. So therefore you got to move it. So when you move it, you have to do a sale. So then the company purchases the property. You'll have to have two solicitors. So it becomes a little complicated because you're doing the purchase and the sale. And on top of that, the banks might also want you, if you're taking a mortgage, to get independent legal advice. So that may cost you a little bit of money. So there's a little bit more solicitor work that you need to carry out. Interest rates, if you're using a mortgage, can be higher than the individual, because the risk profile is different. So the banks see this as a slightly higher risk. So therefore the interest is slightly higher. Also, you got to be mindful that you may have to pay capital gains, right? Because you own the property and you sold the property. Now you sold the property. So you may have capital gains to pay. So that's something that you have to be mindful of. So those are the three main things you have to be mindful of. Of course, there's other factors as well, but these are the main things that you have to be mindful of.
So when you sell the property to a limited company as a person,
Yeah.
you might have to pay capital gains tax.
That's right, yeah. So you may have to. There is allowances. So if you've lived in the property, there's an allowance. Also, if you're rented out, there's a small allowance for that as well. And obviously, if you have done a lot of, say, maybe construction work on the property, or you added an extension, there may be allowances there as well. So therefore, it's always best to sort of consult someone before you do that. I always say, right, sometimes with capital gains, there are a lot of allowances people miss out, right? So it's probably best to employ an accountant who will be able to do this working for you, and you might save a few £1,000s, and it's probably worth paying the accountant something, because you save more money. And always remember, you've got that about 12,500 worth of personal allowance as well for capital gains, right? So if somebody owns properties jointly, that allowance becomes double, right? So you've got that benefit as well. So there are a lot of allowances you can potentially take off, right? So your capital gains, probably want to consult somebody and find out what is likely to be your capital gains number. But sometimes you don't pay anything at all. So if that's been your primary residence and you're just moving it to the company, you may have nothing to pay. So yeah.
Do you still pay capital gains tax if the property is worth less than what you paid for it initially?
So if it is less than what you paid, there is a capital gains, but like I said, if there's these allowances which you can deduct, you may still end up paying less or no tax at all, right?
So then, do you pay capital gains tax in the future if you sell through the company as well?
The short answer is no, but there is a tax you have to pay, right? With the limited yeah, that's right. With limited companies, it works in a very different way. Because with limited company, you pay corporation tax, right? So as it stands, corporation tax is at 19%. So what will happen is whatever gains you make, you'll have to pay 19% corporation tax. But remember, you're not paying double tax, because what happens is, let's say you bought the property for 200,000 and then you moved it to the company for 250. You would have sorted your capital gains at that point. So now from the company, if you're selling it, let's say you made a 50,000 profit. It's on that bit that you pay corporation tax, which is at 19%. Now, one thing to be mindful of is it's not a very straightforward answer, because once you pay the corporation tax, if there is money in the company, which is likely to be the case, you may have to take out dividend, which means you may have to pay dividend tax. Or sometimes there is ways that you may have to pay capital gains on that gain that you made and come out of the company. So it could vary, right? So if you're retaining the money, you may not pay. So there are various circumstances in which you may not pay as well. So if you're planning this thing, it's always good to speak to an advisor and have a plan before you embark on this road.
Right, so going back to your example of 200 and it goes up to 250 when you sell it to yourself as a limited company.
Yeah.
So you pay the capital gains tax on the 250.
Yeah, so it's 250, but obviously you bought it for 200. So you're paying capital gains on 50,000, assuming there's zero allowance, but obviously, like I said, there can be allowances, right? So if it's a joint property, you got 25,000 allowance already. So if you lived in it, you already have allowances. So you may not pay tax on the whole 50.
Sure, but then when you sell it through a limited company and say it's now worth 300,000, so then do you pay corporation tax just on that extra 50,000 from 250 to...
That's right.
Okay.
Exactly. So you pay corporation tax on the additional 50 that you made. That's right. Yeah.
Okay. So then how does stamp duty work for a limited company?
Okay. This is something that gets people. So just be very mindful of this. So a lot of people come to me and say, look, I'm trying to buy this through the company. I will not be paying stamp duty, or I'll be paying basic stamp duty like everybody else because it's the first property of the company. But it does not work like that with companies. Company property purchase are considered as a second property. So if it is second property, you pay that additional 3% stamp duty on top of the standard stamp duty that everybody else pays, right? So it's like buying a buy-to-let, having another property in the background. So the formula is the same. Mm-hmm. But saying that, a lot of people connect this with their home purchase, right? So there is some advantages you can get while you do that.
Okay. So either way, then you still have to pay the stamp duty.
Yes, you do have to pay stamp duty. That's right. Yeah.
So will you save on the stamp duty if you're going to do a let to buy transaction?
Yeah, I think that's the point I was trying to raise before. It is a let to buy transaction. You could potentially save some. Your stamp duty bill will be the same. There's no doubt on that one. But because you're selling the property from your name to the company, if that's your primary residence and if you're buying a new property, then what happens is on the new property, that's going to be your primary residence, you may not have to pay 3% additional stamp duty. So that's how you save, right? But again, stamp duty is a very legal thing, right? Mm-hmm. Before you do this, speak to a solicitor and get this clarified, right? Because you don't want to find out later that you may have to pay stamp duty. You're very unlikely to pay stamp duty because the 3% is something that you may not have to pay because you have now moved the property to the company and that was your primary residence and you're buying a new primary residence. So in that instance, you may not have to pay 3% additional stamp duty. So it works for some people like that. But before you do that, get some legal advice because solicitors can advise you on this subject much better than we can.
For those people who've not heard of a let to buy, because I think most people have heard of a buy to let, but what does it mean to let to buy?
Okay, let to buy is, in a sense, it's kind of the same, right? So the property you're living in, you're putting it to a buy to let, and then you're buying a new property. So that's what you're doing, right? So you're moving your existing property where you live in to a buy to let. And often they raise capital as well when they do that. So that's known as a let to buy. But a buy-to-let is generally, it's not really associated with the property you live in, but maybe you have a second property. Now that, if you buy a new second property, that's called a buy-to-let. So there is a slight difference there. That's right, yeah.
All right, well, thank you, Ifti. Some great advice there. Just wanted to put a reminder out there that these points may or may not be applicable to everybody. So as Ifti said, please do talk to an advisor if you're unsure if these points are suitable for you. And if you don't have an advisor, then I will leave our WS contact details below, as we're always happy to help. And little reminder that as a mortgage is secured against your home or property, it may be repossessed if you do not keep up with the mortgage repayments. Thank you for joining us again today. We'll be back next week for another episode of Let's Talk Money and Mortgages. Stay safe, have a great day, and we'll see you again next week.